warm welcome to our third contribution of our Center of Corporate Transactions and Private Equity at HHL to our podcast series, The Interview. Our center is aiming to discuss important legal and economic issues that are all related to corporate takeovers in Germany. My name is Bernhard Schwetzler. I am professor at HHL Graduate School of Management, and I'm co-heading this center jointly with my partner Benjamin Hammer. Our today's topic is concentrating on rules in German corporate law and its implications for takeover offers in Germany. The title is Endgame, and it will become clear what is meant by this term. In Germany, takeover offers are quite complicated, and I'm happy to introduce my two guests for our today's session, Holger Hofmeister and Matthias Horbach, and it will become clear that both are very well equipped to guide us through this jungle. A warm welcome from my side. Let me start by introducing my two guests. Holger Hofmeister has studied and holds a doctoral degree in law from the University of Regensburg, and he is advising corporate clients and private equity firms in connection with acquisitions and public takeover offers in Germany. My second guest, Matthias Horbach, has also been studying law and also holds a doctoral degree in law, this one from the University of Munich. He has been specializing in advising clients in complex cross-border transactions. Both Holger Hofmeister and Matthias Horbach have been recognized as one of the best German lawyers in M&A by the magazine Das Handelsblatt. Both are partners at the M&A practice of Skadden, Arps, Slate, Meagher and Flom. Skadden is one of the leading law firms in advising clients in corporate transactions. The firm is leading Merger Markets M&A global legal advisory rankings in 2024. And last but not least, Skadden is a long-term supporter of our center. So again, a warm welcome to both of you.
Thanks very much for your kind introduction, and it's a pleasure to be here and participate in this podcast.
Thank you very much for the invitation.
So, let's get into it. My first question relates to German corporate law and the consequences for takeover offers in Germany. The German corporate law offers some say nasty surprises for international investors. A special peculiarity in takeover offers under German law is the so-called Endgame. Due to the strong minority protection, it is extremely difficult, lengthy, and finally also costly for the bidder to get full control and finally own 100% of the shares of the target company. Having achieved the majority of shares in a takeover offer, thus, in contrast to other jurisdictions, the bidder not allow to squeeze out the remaining shareholders who did not accept the offer. And this lengthy, complicated and winding process and the long road to full ownership under German corporate law is referred to as the endgame. And at least to my observation, it still seems to be some sort of a black box for foreign and international investors in Germany. Is this in line with your experience when advising international investors?
So the short answer to your question is yes. On the one hand, our clients are generally very experienced and sophisticated deal makers. So generally, they know what they're up to and how to go about an M&A transaction. On the other hand, as you correctly point out, with respect to German takeover environment, we have this worldwide unique endgame scenario that you definitely need to educate people on at the outset, and then again throughout the process. For many, in particular from a US perspective, it's hard and it takes some time to really fully understand the various integration steps, their order, possible timing, and what it means for potential strategies of hedge funds and other activists. It is clear from the outset, however, that this endgame scenario can result in a cumbersome overall process with a fair amount of uncertainties.
Could you just outline some of the most important rules in this German legal framework for this endgame?
Thank you. I would take it from here for the next question. As both of you have laid out, the endgame, sometimes also called back end, describes a structure which is a bit unique to the German legal system and to the German market. Its basis is a legal framework that exists for German takeover and public to private transactions, and it is particularly relevant for transactions in which the bidder, i.e. the acquirer, wishes to acquire 100% of target shares for cash. Different rules And different structural options apply to share-for-share transactions, and different rules also apply if the bidder does not wish or need to acquire 100%, but would be happy with a minority stake or with a simple majority stake. In situations in which the acquirer desires to acquire 100% in a public company for cash, the deviation or complication is, when comparing with the United States and other jurisdictions, that a one-step transaction does not achieve the intended goal. And therefore, some people call the German structure a 3-step or even a 4-step legal system. In rare cases, 2 steps are sufficient, but the first step very rarely and in practice never achieves the goal of acquirers of this type. The steps 2 to 4 are usually regarded as the end game or back end. The main issue and difference is that a merger transaction, as it is generally used in the United States, is not available in Germany for a takeover against cash consideration. This is because the merger structure requires that shares are delivered and handed over to the shareholders of the entity that will cease to exist. For cash transaction, such delivery of shares does of course not work. There is one exception. If the acquirer already holds 90% of the outstanding shares, then a limited cash merger is possible, but only to squeeze out the remaining 10% and only in that very situation and not in others. The lack of a merger structure being available means that after the first step, further steps have to follow. The first step is the usual takeover transaction. The takeover transaction is subject to the German takeover rules and is lengthy and rather tightly regulated. It starts with a decision to launch a takeover offer, followed by the obligation to prepare an offer document and submit it to the German regulator BaFin for approval. Following review and approval by BaFin, the offer document needs to be published and the offer launched. The offer shall be open for between 4 and 10 weeks, and only after that, the first part of the offer period ends and the first closing can take place. And after publication of results from the first part, a second offer period of 2 weeks starts, with a second or single closing to follow. With that process for the first step in mind, you can see that minority shareholders and also funds have the opportunity to take various actions while the transaction is ongoing. They can buy shares, sell shares, build up positions, and behave in a way that is not controllable by the bidder or even the target company, and thereby bring the acting parties in a situation which is less certain, less clear, and more difficult than what we see in other jurisdictions.
Okay, thank you. And that, of course, begs the question on whether there are particular strategies for bidders to navigate through this, let's say, legal journey to finally get to the desired 100% ownership.
So in practice, the first thing actually is to figure out together with the client whether you really need to get to the 100% ownership, also given the endgame aspects. And in a meaningful amount, I would say, of cases, this is not the case, at least not with the pressure to get it done very shortly after the offer. But if you want to get to the 100% as fast as possible, you should think about it from the back end, which means to get to 100% ownership, you need to implement a squeeze-out. And under German law, you essentially have 2 squeeze-out alternatives. Alternative 1 is the regular squeeze-out, that in particular requires that the bidder has a 95% shareholding in the target. Alternative 2 is the merger squeeze-out that Matthias just referred to. It means that in the course of the squeeze-out, there is a merger of the target entity into the bidding entity, and here the shareholding threshold is only 90%. And while both alternatives work in practice and have indeed been applied in the past, in most cases that we see, parties indeed make use of the regular squeeze-out. So then the question is, how do I get to the 90% or 95%? And as Matthias already pointed out, indeed only very rarely you will end up with a shareholding in the target of at least 90% alone through the offer. So from experience, I'd say you generally may end up somewhere between 50 and 70%. Of course, depending on any minimum acceptance threshold that the offer may provide for and which is not waived. So one piece of the strategy is always to attract as much attention and acceptance of the offer as possible. And the key factor for that is an attractive offer price, including an attractive premium. In addition, you indeed have a couple of other features that you can play with, all aimed at excluding speculation and mitigating strategies of hedge funds and others to play the end game in their favor. One tool in this respect relates to a domination agreement. A domination agreement gives you the opportunity to effectively control the target and allows you to access the target's balance sheet, even if you have significantly less than 100% ownership. The execution of a domination agreement requires the bidder to purchase all shares that the minority shareholders want to sell at a price that may be higher than the offer price, depending on the stock price and a separate valuation of the target by an auditor. So, to exclude speculation of hedge funds and others for a higher price, we've seen bidders proactively excluding the execution of a domination agreement for a certain period, usually 2 or 3 years after the offer closes, really to deliver the message to the hedge funds and others, you don't need to wait for it, tender your shares now. You can play it, interestingly enough, also the other way around. So we had that. The bidder expressly confirms that as soon as possible, it wants to implement the domination agreement, which confirmation is accompanied by an indicative valuation of an auditor or valuation firm, indicating that the price that would be payable for the minority shareholders' shares under the domination agreement would actually be lower than the offer price. Of course, that only works if that is the case in a specific situation. Other features could include announcing that you would want to avoid dividends and would not support dividend distributions in the future. So these are all elements that you would try to implement to make sure that in the first place you receive as much shares as possible through your offer. But as said before, usually you end up with somewhere between 50 and 70% shareholding. So then it can indeed get a bit nasty, and subject to the individual case, you can hardly really plan in all detail how to get to the 90 or 95% and how long exactly it will take you. You can, of course, acquire shares over the stock exchange, and you can perhaps enter into additional arrangements with other shareholders to acquire their shares. But usually that road ahead provides various uncertainties, and you have to closely monitor the developments and a little bit decide on the fly.
So, that has some significant side effects that are very special in Germany. At our chair, we have collected a large database collecting all takeover offers since the year 2005, and we see that almost a quarter of these offers is made from a bidder that already has a stake of more than 75% of the shares, which is then to be interpreted as one of the means to grab and collect the missing 10 or 15% to make it across the threshold of the squeeze-out that you mentioned. So as I said, we have some very special conditions under German law. My second question relates to something that you already have mentioned, that is the strategies and intervention of hedge funds into the process. Hedge funds have been increasingly engaging in German takeover offers, and they try to exploit this opportunity that is given by these special German regulations. Hedge funds frequently acquire shares of the target companies even after the takeover offer has been announced, and they, of course, are aiming for either an increase in the offer by the bidder or, if the offer succeeds, on a higher compensation in these structural measures that you have mentioned, that is, the domination agreement and the squeeze-out. Could you just elaborate a bit on the consequences of these hedge fund strategies and interventions and the potential countermeasures for the bidder?
Yes, of course, happy to. As you've just mentioned, there are different hedge fund strategies and different types of hedge funds. Some buy and sell during a takeover process and are thus not active in the endgame trades. Hedge funds that are active in endgame trades are prepared to stay involved and remain invested after the takeover offer has closed. They wish to benefit from the corporate transactions, steps 2 to 4, that take place thereafter, in which can include a domination and profit and loss pooling agreement, a squeeze-out, maybe a delisting, a merger, or other type of corporate transaction. The goal of these hedge funds is to achieve a better, higher value for their shares in those corporate transactions than they would have generated by tendering their shares into the offer. So it is really their rationale, their investment rationale, that prices go up at a later time because bidders come under pressure to achieve certain goals, and one goal would be to reach 100% of all shares, or at minimum access to the balance sheet of the target, whether for acquisition finance, integration, or other purposes. Such access requires control over the entity, which can be conveyed by a domination agreement. Such an agreement does not fully establish the flexibility of a 100% holding, but it is close, and it is sometimes required for acquisition finance purposes. Banks often require access to the target cash and collateral over target assets, so that within a certain period after step 1, after the takeover offer, those assets and cash need to be available unless agreed otherwise, and the only means to establish such availability is to have a domination agreement in place. In those situations, hedge funds can build up a position and then just wait until the request for a domination agreement comes around. At that time, they have a strong position in the vote over the domination agreement because such agreement requires a shareholder approval with a 75% majority of the votes present at the meeting. This is one and the primary angle of those hedge funds that stay invested. Another one exists in connection with the squeeze-out. In this context, hedge funds can pursue the same goal and be in the same position. As Holger has already said, if they hold more than 10%, hedge funds will be able to block a squeeze-out entirely, and that would include the more complex squeeze-out combined with a merger. The simple squeeze-out requires that outside shareholders hold at minimum 5% plus one share, so if that type of squeeze-out were desired, it is even easier for funds to build up a position that gives them leverage. And for those positions, they normally demand a higher price than the price that was paid and offered in the takeover offer. Now, we'll get later to the problems that this creates for the bidder, but as such, funds hold a strong position. In connection with the domination agreement, they even have the option to stay invested if they wanted to and receive a dividend, a guaranteed dividend, as long as the agreement is in place. And the alternative, they can exercise a put option that is part of the domination agreement and be bought out at the fair market value. The fair market value is often subject to dispute and then bears interest, significant interest at 5% plus the base rate, which currently is at 1.27%. So outside shareholders, including funds, would earn more than 6% in interest alone by disputing the price that is offered in the domination agreement proposition. So there is potential hold-up value for hedge funds and other shareholders after the takeover offer has closed. Now, what can acquirers and bidders do in that situation? A couple of things, and Holger already mentioned some of them. One is for any bidder and acquirer to find out and monitor very closely who is investing, because that will give them a view as to what strategies are being implemented and pursued, what kind of hedge funds are involved, what they want to receive. It will also inform as to whether the relevant hedge funds can hold shares for a longer period and whether they can hold shares traded only on an unregulated market. A delisting can be beneficial if hedge funds are not permitted to hold such shares. Depending on those results, a strategy can be developed to put funds under pressure. Another option is, as Holger mentioned it, to communicate very clearly with the actions, corporate actions that will not be taken, so that funds can make their own assessment as to whether it is worthwhile to pursue shares, to purchase shares, and to stay in the stock. This situation exists, for example, if the acquirer decides that it is acceptable to stay at 75 or 80% for the medium or long term, or at least as long as hedge funds are involved. Thereby, the incentive to invest into that share and obtain a blocking position is less prevalent. Then we've seen approaches to hedge funds, discussions with them, and attempts to motivate them to tender into the offer. Those discussions can be supported by DCF or other fair market value appraisals that might show that not a lot of upside can be expected, and thereby not to let them in the dark as to the lack of potential benefits that they might reap. The other way would be to communicate that for 12 months or another period of time, no further steps will be taken. During such 12 months after the offer, there is a significant risk for the bidder when paying a higher price, whether in an agreed domination agreement or in another sale or acquisition process, that a top-up has to be paid to the minorities that tendered their shares in the takeover offer. In order to avoid that risk, the bidder can wait for 12 months and not do anything during that period of time. Such 12-month period might be too long for a hedge fund to wait. So there are quite a few options to address hedge funds' activities and discourage back-end trades. Accordingly, our regular advice is to consider all options to see which ones can work, find out as much information as possible about the investor base, and to openly communicate which actions are proposed and which will and will not be taken, and thereby significantly reduce the number of hedge funds that might be open to such trades.
Thank you. One has to add here that, of course, not every bidder has the option to wait for 2 or 3 years, especially if you think of financial bidders and private equity bidders. Of course, they are also interested in shorter settlements of this and solutions for that problem. So I would like to add a little sidebar here. Our center recently has published a study analyzing the factors attracting hedge funds to step in after the offer announcement. And we found that the shareholder structure of the target, especially the fraction of ownership of ETF, that is exchange-traded funds ownership to have a significant positive impact on the probabilities that hedge funds show up and step in. Our interpretation of this result was that ETFs cannot easily tender their shares into the offer, and such are, so to speak, sticky owners that are not able to accept the offer, and by doing so, they of course increase the bargaining power and the hold-up situation that is created and finally used by hedge funds that are pressing for a potential higher offer. So my third and last big question is centering around a particular legal question that has been triggered by a recent judgment from the German Federal Court of Justice that may have a significant impact on the strategies of the players in such a takeover endgame in Germany. Could you please elaborate the key factors of these judgments?
Sure, thanks. So the case at hand relates to the takeover of German pharma group Stada by Bain and Cinven back in the summer of 2017. And the main legal issue the court had to deal with related to the offer pricing and the potential top-up payment to shareholders that may need to be made after the offer closes and that Matthias just referred to. So German law says that if you acquire shares in the target within 12 months from the closing of the offer outside the stock exchange and you pay a higher price, so higher than the offer price, then you need to pay the difference between such higher price and the offer price to all shareholders that accepted the offer before. This rule is accompanied and supported by other statutory provisions, and pursuant to one of them, an arrangement pursuant to which the disposal of shares can be requested is put on par with such post-close acquisition itself. Now, in terms of the key facts of the court decision, the takeover was run by an SPV that was owned by Cinven and Bain, and with the offered share price of roughly 66 euros, the offer was successful. Subsequently, I think it was in August 2017, the intention was published to execute a domination and profit and loss pooling agreement. And at the end of August, there was another announcement that the SPV and Stada shareholder Elliott had entered into what they called an irrevocable commitment. In substance, under such irrevocable commitment, Elliott was obliged to vote in favor of the domination agreement if the cash compensation per share that was offered under such agreement was at least 74 euros and 40 cents, so about 8 euros higher than the offer price. The irrevocable commitment specifically did not include an obligation of Elliott to accept the share purchase offer that has to be made as part of the domination agreement. So Elliott was only obliged to vote in favor of the domination agreement. They were not obliged to sell their shares. Then subsequently, the domination agreement had in fact been entered into, and now the claimant came and the claimant requested to be paid the difference between the purchase price that was provided for in the irrevocable commitment of approximately 74 euros and the offer price that he accepted in the offer of 66 euros. As a quick excursus, just to note, Elliott did not accept the cash offer that was part of this domination agreement, but they waited a little bit longer and tendered their shares into the subsequent delisting offer for a price of about 81 euros. So this is a nice example of how the backend may work out and how the various integration steps could play together and how it could become more expensive for the bidder over time each time you implement a next integration step that triggers a requirement to buy out minority shareholders.
So what are the key rulings then coming from this judgment?
The first two instances, which were the Regional Court of Frankfurt and the Higher Court of Frankfurt, they rejected the claim. And only the Federal Court of Justice ruled in favor of the claimant, demanding the SPV to pay the difference. The most interesting pieces of the court's decision were how the court viewed the irrevocable commitment and how the court qualified the irrevocable commitment with respect to the price and the German pricing rules I explained before. So the court considered the irrevocable commitment an arrangement that was put on par with a post-offer close share acquisition within this 12-month period. While this view did not completely come out of the blue, it was still a bit surprising, basically for two legal aspects that the court had to form a view on. And the first aspect was that under the irrevocable commitment, as I said, Elliott was not obliged to sell its shares, so there was no right of the SPV to request the transfer of the shares. Now, when considering arrangements that are put on par with the post-offer close share acquisition, it was prevailing view in German legal literature that this would only apply if the bidder is indeed entitled to acquire the shares and to request the transfer. It was not sufficient that only the other shareholder had a right to sell its shares. But apparently the court did not follow that view, arguing with the wording of the relevant statutory provision that it does not specify which party has a transfer right, so it could indeed be either of them. And then the court also applied some other standard interpretation rules under German law that in the court's view supported its ruling. And the second aspect was that under the irrevocable commitment itself, really, if you look at it, no party could request a share transfer. So the irrevocable commitment was apparently crafted very carefully and thoughtfully to exactly cater for this aspect. The commitment only provided that Elliott had to vote in favor of the domination agreement. And there was no obligation of Elliott to sell its shares, and there was no obligation of the SPV to purchase Elliott shares. The court now got somewhat creative, referring to a previous ruling the court made, pursuant to which it does not need to be one act that leads to the share transfer, but that it is sufficient if it is implemented by several acts taken together. And the court now argued that indeed the execution of the irrevocable commitment was the first act, and the second act actually was the execution of the domination agreement itself, because, as explained before, under the domination agreement, on the basis of mandatory law, each minority shareholder has the right to sell its shares to the other party. And this kind of two-act combination led the court to consider the irrevocable commitment an arrangement that is put on par with a post-offer closed share acquisition. And that's why the court eventually ordered the top-up payment needed to be made in the starter case.
That top-up, if I may, can become very expensive for a bidder. It sounds simple to say, well, there's a top-up to be paid. Big but is that the top-up is to be paid to every shareholder who tendered their shares into the takeover offer, which often can be 70% or even 80% of the entire shareholder base. And those shareholders were happy in one way with the offer price, because otherwise they wouldn't have tendered their shares. But they now, years later, and including interest, receive a top-up payment they did not ask for. This makes it, in the aggregate, for all those shareholders, a real risk and an expensive exposure for the bidder that is being put on it here. So what does this court judgment now mean in practice? Some people are saying, even by signaling or reviewing or making a general positive statement, acquirers are entering into an implicit arrangement that could lead to exactly the very significant risk for any bidder or acquirer having to make such payments post the endgame scenario. So in my view, the landscape has changed quite a bit, and it is hardly advisable for a bidder or acquirer to take those actions, at least within a 12-month period, and to reach a corresponding agreement with the acquisition finance lenders. Such actions only appear possible if all actions can be controlled, monitored, and reviewed very closely to avoid and reduce that risk. But this requires a high degree of caution and continuous review. You can also turn it the other way and say the court judgment operates as a disincentive for hedge funds to buy, because bidders will not do a deal with them later on. That could well be so, but you never know how this turns out in the end. Options and strategies are continuously evolving, and we will see how market participants are reacting to the change in landscape.
So thank you. That is already in part answering my last question, but of course, you can add additional thoughts to that. The question that is backed here is simply, what does that mean for the parties, these rulings in a takeover offer under German law? Did you already observe some changes in the behavior, in the strategies of bidders, hedge funds, targets, and potential other players?
Yeah, so Matthias just summarized it very well. Indeed, so what we know now is that we have that precedent decision of the Federal High Court of Justice confirming how broad he wants to apply that specific rule of German law. And indeed, you now need to be very careful and very thoughtful about arrangements that might lead to a share acquisition within the period of 12 months after the offer closed. So if you think further and look at the hedge funds, for example, their toolbox shrunk a little bit. So the way to do it, like the parties did in the starter case, is no longer viable. From a bidder's perspective, this means that you have less options to deal with scenarios like that, unless you pay everyone who accepted the offer. But if you turn it around, and Matthias elaborated on that as well, then because now each investor can rely on that ruling and there is less uncertainty in terms of post-offer close bilateral deals, investors can be a bit more relaxed about accepting the initial offer. which in turn makes their behavior in terms of accepting the offer a bit more foreseeable for the bidder and can help when considering and forming the right strategy for the offer.
Thank you. To conclude at the end, only one thing seems to be sure in this environment. The takeover offers in Germany will still be very complicated. And of course, there will still be a high need for qualified legal advice. So thank you very much for being with us today. And I hope to see you soon in other related legal questions, if I may.
Thank you very much.
Thank you for listening to the Center for Corporate Transactions and Private Equities podcast, The Interview, Episode 3, originally recorded on November 5th, 2025. This podcast is produced by the CCTPE together with its partners and sponsors. This video is material of the CCTPE and Skadden and may not be copied, distributed, published, or reproduced without prior consent. The information presented is for educational purposes only and does not constitute research or a recommendation. Neither HHL, Gemeinnützige GmbH, CCTPE, nor Skadden, ARPS, Slate, Megher, and Floam, LLP, nor any affiliates guarantee the accuracy or completeness of the information provided. Views expressed are solely those of the speakers and do not necessarily represent those of CCTPE or Skadden, nor any affiliates. No financial, legal, or tax advice is provided. Receipt of this video does not establish a client relationship or constitute investment advice.